I'm Joe DeLisi, and this is the Joe DeLisi Financial Advisor Podcast. Welcome to 2025. It's been a couple of weeks since we've spoken. A lot of stuff going on as of this recording. Yesterday was the January 6th, so the new president is cleared to come in, and that puts a very contentious election behind us. We can now focus on the country and doing what the new president would like to do, and to see where that leads us, at least economically, from my perspective. But today, what we're going to talk about are stocks, and I hesitate saying this. I hesitate titling this podcast this title. But look, we got to have this discussion because this podcast is primarily for my clients, and my job is to save you guys from potential problems, from financial death, so to speak. This podcast is also for financial advisors who listen to me, who I've kind of created a little bit of a following over the years, and maybe this can help by extension through them, their clients. So my question is it time? Is it time to sound the alarm on stocks, and specifically the S&P 500? Now, the answer is no one knows, and I'm not going to change that. I'm not going to sit here and try to predict things and speculate and gamble, which I've told you repeatedly that we're not going to do. But we do have to ask the question because I'm deathly afraid of both what I see in new clients' portfolios as well as my current clients being swept up in comparing everything to the S&P 500 index. I was referred to a new client yesterday. I looked at her stuff, and 85+% is in, you guessed it, S&P 500 stocks. She has an advisor. He or she, in my opinion, is either lazy or gambling with the client's money, and we're not going to do that here. Because, look, and this is, if you're my client right now and you're looking at your returns and you're trying to compare that to the S&P 500, again, I'm sounding the alarm. You cannot sit back and take a diversified portfolio designed to get you expected returns that are smooth over time and compare it to one market, no matter how big that market is, no matter how well that market has done recently. Because those of you who are doing that and who are over-indexing to the S&P, look, it's just not likely to end well for anybody unwilling to take stock of what has happened in the past and to take that and apply it to lessons to the current environment. So the following is me trying my level best to plead with current and prospective clients and advisors. Please do not let greed or fear of missing out drive portfolio decisions. So let's go back again to the 2000-2002 market downturn. And this is often referred to as the dot-com crash. This had a significant impact on investor portfolios and me, particularly for those overly concentrated in the S&P 500. Look, I was there, and here's what happened. First of all, let's have some context. During the late 1990s, and let me just also say this, if your advisor isn't willing to build your portfolio based on data, and they weren't around, if they weren't in the business, and they didn't go through this back in the early 2000s, you need to question them as to why they're doing what they're doing. Because again, I was there and I saw it. And here's what happened. During the late 90s, the dot-com boom led to an overvaluation of technology stocks. The S&P was heavily weighted toward tech companies because its composition is market capitalization weighted. And that's still true today. So by 2000, tech stocks accounted for approximately 35% of the S&P's total market cap. That's according to Morningstar. Now, when that bubble burst in early 2000, the S&P suffered significant losses. Over the 3-year period from March of 2000 to October 2002, S&P declined about 49%. Let's just call that by half. Now, and that's all according, again, just to S&P data. I was there. I saw it. I lived this as a relatively new advisor. I think I was maybe 3-4 years, 5 years in the business at that point. And I walked alongside of my clients and I vowed, look, I am never, ever going to let this happen to people again. I was actually trained to let people make those decisions and to over-index their portfolios that way. That's how I was trained by my own industry. Not going to happen ever again, not on my watch. So here are the impacts of that. Number one, the losses from the over-concentration in tech. Well, investors with portfolios heavily concentrated in the S&P were disproportionately, as you can imagine, they were disproportionately affected because of the index's tech stock dominance. Now, I'm talking about 2000, but we could be talking about today. Now, back then, it was high-profile companies like Cisco, Intel, Microsoft. They saw stock prices plummet, wiping out substantial wealth. There was research back then from JP Morgan that said that diversification across sectors was very limited within the S&P 500 because of tech dominance. And that just exacerbated losses. So does that sound familiar? Because that's where we are right now. I'm not predicting a crash. I'm just saying this is where we are right now in the S&P 500. Now let's look at the recovery. So the S&P took over 5 years to recover those pre-crash levels back in the day. Unlike portfolios diversified across other asset classes like international stocks, bonds, small cap, and value equities. Those rebounded much more quickly because of the diversification. And it's critical to note, it took 5 years to rebound only if you never sold and just rode it out, which in my experience, very few people did because they were scared. I mean, you have to go back and think about what was going on during that crash. This was 9/11 and the recession. It was scary. Every crash is scary. There's always something going on. It's not just markets go down by a percentage and a number and ink dots on paper. There's always something else going on with it. And so you can't just look back in time and say, well, those silly ducks, if they had just held, well, it's not that easy, when you're going through something very, very scary like that. And so again, in my opinion, very few people actually held. So their recovery would have taken substantially longer than 5 years. So what were those effects then? Well, again, from what I saw, investors faced significant emotional strain. And even there's a study in, I think it's the Journal of Financial Planning. I believe this was 2003. I'll have to look that back up again, but I'm almost positive it was. They noted that many individuals sold their investments at the market's lowest points, which would crystallize those losses. It would lock them in. And again, while anecdotal to my own business, I can tell you this is exactly what many of my clients did during this time. And I regret to say, as a young advisor, as a kid in the business, 4 or 5 years in, I didn't have it in me to be able to talk them out of it. I didn't have it. I didn't have the knowledge. I didn't have the experience. I didn't have the wisdom that I do now. And that I have really over the past 10 to 15 years, having gone through that. As an advisor now, 28 years in this business, it's a radically different approach than somebody who's in for 4 or 5 years. It just is. I'm not beating those up. I'm not beating up young Joe. He just wasn't ready to deal with what was going on. It was a horrible time for a new advisor. Now, let's go back and let's compare. So, because what am I asking you to do? I'm asking you to have diversified portfolios, which is what we build. So diversified portfolios, including bonds, international stocks, they performed way better during this period. For bonds, for example, gained value as interest rates declined during the recession. It served as a buffer. Now, we're not looking for return from bonds in our portfolios. We want high quality, very short duration bonds. But we are looking for reduction in volatility, downside volatility, which is what bonds provided back then. They sheltered us from that downside 49% loss. And also, surprisingly, U.S. small value stocks, and I say surprisingly because that's a relatively risky asset class, those came to the rescue for diversified portfolios because clients with those had very strong gains in those 3 years. It's according to the Fama French Research Index. So what are the lessons from this? Because this is the critical part, right? We have to have some lessons from this. The 2000 to 2002 crash highlighted the risks of overconcentration in a single index or sector, or God forbid, a stock. It emphasized the importance of diversification across asset classes, geographies, etc., to mitigate risk during downturns. Subsequent changes in portfolio management strategies, including greater emphasis on asset allocation, stemmed from this experience across the financial industry, and especially in my business. But in my opinion, that didn't stick because the vast majority of new clients are significantly overconcentrated in the S&P, in their brokerage accounts, in their 401k accounts, and in their IRAs. And now look, maybe that party never ends. Maybe the S&P just continues to grow forever. Maybe 100 years of data and 10,000 rolling 1 year time periods, we just throw that in the trash and say now the S&P will just continue to grow at 20 to 30% a year forever, which, by the way, is exactly what I was taught when I was brand new in 1998. I was taught there was a new economy and equities wouldn't go down anymore in America because of the internet stocks. So maybe this time it does happen and it just goes up forever. But is that really a risk worth taking? Is this time different than the hundreds of data points, thousands in the past that suggest it's not different? Because the concentration of the S&P 500 has reached unprecedented levels, surpassing even the peak observed during that dot-com bubble. So here's an analysis of that. Let's talk concentration levels. 2000, at the height of the dot-com bubble, the top 10 companies in the S&P accounted for about 27% of the index's total market capitalization. That's according to Goldman Sachs. Now, at the end of last year, December of 2024, the top 10 companies of the S&P 500 represented over 37% of the S&P 500's market cap. 27% the dot-com bubble, over 37% now, indicating a significant increase in concentration compared to 2000. That's according to the Capital Group. You'd know them as the American funds. Now, let's look at some specific companies. So in 2000, the leading companies were in the S&P were predominantly technology firms like Microsoft, Cisco, GE, Intel, and even Exxon was considered a tech firm back then. That's according to Standard & Poor's. Current market is dominated by, guess what? Tech firms. We call those what? The Magnificent Seven. And you know them. You could say them instead of me. Apple, Microsoft, Amazon, Alphabet, which is Google, Meta, Facebook, NVIDIA, and Tesla. Now, collectively, these companies account for nearly $16 trillion of the S&P's total $46 trillion market cap in mid-2024. In fact, if you took those stocks out of the mix, the S&P underperformed international stocks, which have not been doing great. So compared to 2000, we're in a worse spot now from concentration in individual companies. So what are the implications of this? Well, the increased concentration obviously means the performance of the S&P is heavily influenced by a few very, very large cap tech companies. This was evident in 24, where the S&P 500's gains were significantly driven by those cap companies, and investors relying solely on the S&P for diversification. Look, you may face very heightened risks due to this concentration because you're not really that diversified. You basically own 7 companies. And a downturn affecting these major companies could severely impact the overall index performance and your money and your ability to retire or send your kids to college or buy that vacation home or whatever it is that you're trying to do. So at the end of the day, the S&P's concentration in 24 has far exceeded levels we saw during the 2000 dot-com bubble, with a small number of tech giants exerting substantial influence over the index's performance. This underscores the importance for investors to assess their portfolio diversification strategies carefully. Look, you're not trying to get 20 and 30% hits on your portfolio. You're not. Most of you, if you've done proper planning, you're looking for, what are you looking for? 6, 7, 8, 9, maybe 10% a year on average? Great, we'll take 30% when we can get it. But that's greed. That's fear of missing out. That's my neighbor got it, why didn't I mentality. And that is exactly what led to people's portfolios getting wiped out in 2000, 25 years ago now. And again, I haven't seen these lessons being learned. It's because time, what do they say? Time eases all pain or erases all wounds or something like that. But you can't afford it. If you were 25 back then, years old, you're 50 now. You can't have a 50% wipe out of your portfolio and hold it to hopefully get back to even in 5 years. Now you're 55. That's if you held it all. And if you make the mistake of selling it all at the down, at the bottom part, it could take you 10 to 15 years. The NASDAQ took 15 years to recover. So I'm pleading with you. Okay, it is time to sound the alarm on the valuations of the S&P 500. Are we predicting anything? Absolutely not. I don't know when that party ends. I just know that everything basically has to revert to its mean eventually. Now, that doesn't mean a crash. That could just mean 15 years of 4% returns. And while I know there's a bunch out there laughing when they hear that, I'm just using math. Again, not predicting anything. But we don't need to do that. We don't need to speculate. We don't need to gamble. We don't need to predict. We just need to have a scientific portfolio methodology to build an allocated portfolio and to stick with it. And that's my job for you. Okay. Now, here's the compliance. Registered representative, financial advisor, Park Avenue Securities, LLC, Pass OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, California 92121. 619-684-6400. Securities products and advisory services offered through Pass member FINRA SIPC. Financial representative, the Guardian Life Insurance Company of America, Guardian New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. California license insurance number OD34103. This podcast is for informational purposes only and not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that the individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and firms are not affiliated with or endorsed by Pass, Guardian, Westpac Wealth, and opinions stated are their own. Guardian and its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, accounting professional regarding your financial situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation or to otherwise act in a fiduciary capacity. Past performance does not guarantee future results. Indices are unmanaged and one cannot invest directly in an index. 7490224.1 expires January 2027.